Okay, good day everyone. This is United Hampshire REIT's third quarter 2023 operational updates dated 9 November 2023. Right, this REIT is focused in US, in the grocery anchored shopping centers and self-storage areas. Right, it's sponsored by UOB as well as Hampshire. UOB is a very well capitalized and managed bank in Singapore. Right, so the asset arm of UOB actually sponsors this REIT. Okay, since UOB is actually more or less focused in Southeast Asia, right? Hampshire is the US property specialist that helps to anchor this REIT, right? So these are the two sponsors of the REIT. Right, we look at third quarter 2023 key highlights. This data is as of 30th September 2023, right? So US economy is still expanding, right? They have high committed occupancy for grocery and necessity properties, 97.2%. Right, long WALE, high retention rate since IPO in 2020, I believe, 92%. Right, little expiry in this year and next year. Little refinancing required in the next 2 years. This year they are done. They don't have any more refinancing. Next year they have only 6.6%, after which their next step is in November 2026. Right, so fixed rate debt at 81%, and of course, lately they finished construction of some building. Right, so this is a building that they just finished on excess land, and they say that they finished it ahead of schedule in November 2023, and this store will enhance the financial performance of the property, and also expected to generate a significant increase in footfall at the property. Right, so this is a good thing. Right, look at the financial highlights. Right, revenue is going up, which is a good thing. Okay, we look at net property income also going up, right? Distributable income has fallen, right? When we look at the performance here, the good things are new leases and rental escalation from existing lease, contribution from Upland Square, which is a new property acquired in July 2022, right? So these are the good things. The bad things that happen are high interest rates, expense due to rising interest rates, right? So this caused a near-term drop. You can see here, the latest quarter DPU has dropped by 5%, as opposed to overall 9 months it dropped by 0.3%, which means that the latest quarter is the culprit towards the underperformance, right? So this is the problem here, right? So high interest rate is also affecting this REIT, and it also took on additional loans to acquire Upland Square, right? Management electing to receive management fees in cash, I think also contributed to the drop in DPU, but I believe that this is the right move given the share price weakness lately. Right, so they are saying here that the good part about them is they have very little debt here to refinance, right? And most of the debt in 2025 has been shifted over to November 2026, which hopefully the interest rates have come down by then, right? The most recent talk from the Fed seems to be that interest rates have peaked, right? We are hopeful that next year there's some drop in interest rate, although how much it remains to be seen, right? The leverage is actually quite high at 41.7%, interest coverage ratio 2.7%, right? And which is normally we like to see 3, so this debt summary isn't that great, right? And the weighted average interest rate is 4.04%. Okay, I'm hopeful that this will not increase too much because they only need to refinance very little as a percentage of their total debt next year, right? So only 6.6% of their debt is due for refinancing over the next 2 years, more or less. Actually, 2.5 years, only 6.6, maybe 2.5 years or so, slightly more than that. So hopefully this 4.4%, which is higher than like other REITs, like for example, CapitaLand Integrated Commercial Trust, which is something like 3.2%, I believe, right? But they also say they are going up next year, right? So hopefully if they can keep 4.4% interest rate roughly constant, I expect it to go up, but not too much, right? Then their DPU will not be too badly affected, right? So if you recall, the latest quarter's drop in DPU is 5%, right? So we're taking the worst case here, right, and extrapolating it a little bit more. So let's assume that this 13% of DPU they are giving, let's just extrapolate the worst case that they drop by 5%, right? And I think that's still very high as compared to the average of the S-REIT world, right? If we are comparing to the US office REIT space, which is things like Prime and maybe Keppel Oak, I think it's comparable to Keppel Oak, and of course Prime has more is higher percentage of DPU, but I think that is a reflection of the risk that exists in Prime, right? Keppel Oak, I think to compare United Hampshire with the US property side is a little bit unfair to United Hampshire because they are not in the same space with demand issues, right? So it's like for office REITs in the US, there's a demand issue. People are moving out of the offices to work from home a little bit more, right? But I think United Hampshire is in a space whereby the demand for groceries will always be there, right? They have to buy groceries. Right, so anyway, they are showing here their grocery properties and necessities. Grocery and necessity properties have always had high occupancy, right? And you can see the customers that they have are all very big names, right? This is the self-storage properties, right? They only have two, right? And you can see that it's more or less constant, right? The occupancy, although there's a slight dip here, I believe, right? They say that there's an supply in the self-storage facilities in the areas that they operate in, right? So as compared to the average of 6.2 square feet per capita, the areas they operate in has only 3.3. So they, I think, expect that possibly the rental rates should increase, right? So yeah, so these are the tenants. They're just pretty big tenants, right? And here they show that their tenants are actually doing well, right? So they should expect the tenants to stay, right? US outlook for economy remains strong. I think the most important thing is the inflation rate. Recently, it seems like the Fed is more concerned about recession than controlling interest rates. Than controlling inflation, because inflation seems to already be roughly under control, right? Of course, this may change, right? And the outlook for spending, right? They're saying that grocery sales has gone up, right? Discretionary sales has gone down, right? So this one is when people's budgets are tight, right? So things like they'll cut down on things like furniture and home furnishing, right? Electronics and appliances, sporting goods, hobby. These things are more optional, but where this REIT is focusing in is on the grocery and necessities, right? So in these areas, even if inflation hits you really hard, you still have to spend in these areas. So I believe that that's where the strength of this REIT lies in, right? So they say that they are cyclical agnostic. That means they're not a cyclical kind of REIT, right? So for example, cases like maybe banking, I don't know, things like shipping and maybe semiconductor are cyclicals, right? So these are things that have very high booms. When they make money, they make a lot of money. Then there may be large periods whereby they don't make so much money, or they make losses and they need to try and survive, right? So, and cyclical agnostic means that they believe that the REIT is actually immune to all these boom and bust because of what the reasons that we mentioned earlier. You still have to buy your groceries, right? So yeah, so they say that they focus on the affluent and populous US Eastern Seaboard markets with higher spending power, lower supply, and lower supply growth. So they are in an area whereby the population is wealthier, right? And then the things that yeah, I think the dividend is attractive based on the fact that I don't believe the asset prices will be revalued lower as opposed to the US office space, for example. Right, so this is the areas that they are in the East Coast, which is richer, right? This is their self-storage property areas, and finally, this is their journey since listing, right? Right, so with that, I'll end this presentation. Thank you for listening.